1996 when we entered the university together. We graduated together. Of course, he was a little bit, higher average than I was. Shut up. Ziad, obviously, he had his bachelor's degree in business administration from the university. Went on to do an MBA in finance from Coventry School of Business, and finally a PhD from the University of Washington in public policy and management. Ziad has also authored several researches and has done extensive work on the subject. So I will turn the floor over to him. Please do with them what you will, what you always do to your students. And thank you, Ziad.
Good evening. Thanks so much for me. First of all, we have to realize that it's a long, complex topic, seriously to be covered within 60 minutes. Taking into consideration that when I lecture my students about this topic, I know them, I know their backgrounds, I know what they need. But here, I don't know nothing about it. I don't know what's their background, I don't know what you're good at. I have no idea about the previous information, so you have to take into consideration that some of the slides may be easy, some of them may be harder than others. But again, I welcome any interruption. Don't hesitate to raise your hand and interrupt me anytime you want. Ask any question you like. If you think that the English language is somewhat hard for you to understand, or the concept doesn't make any sense in English, I'm happy to talk in Arabic as well. Having said that, let's start. So today's agenda will cover 5 different topics. First of all, I will just provide you with a short introduction about the importance of financial management for personal needs and for business needs. Why every one of us should be, to an extent, familiar with the basic concepts in financial management. Now, when I talk financial management, that means I will bring in some concepts in finance, some concepts from economics, some concepts from management, some concepts from international business. I just chose financial management as a general headline for the presentation, but that doesn't mean I won't venture into different other topics. Then I will talk slightly about the concept of opportunity cost in making decisions. We will move then to the eternal relationship between risk and return. We will explain what is meant by risk, what is meant by return, and what's the relationship between risk and return in terms of business, in terms of the startup risk. I will explain risk by differentiating between 2 types of risk, systematic risk and unsystematic risk. We will talk about them, we will provide some examples of these 2 different types of risks. And we will talk how these 2 types of risks may affect each business within your example. Finally, we will talk about the major financial statements that businesses usually provide for banks or investors. And the group activity or the exercise actually will be related to the financial statements. Now, having said that, can I just ask you, if you can raise your hand, if you're familiar with any 2 of these different topics? Any person who's familiar at least with 2 of these different topics? Can we raise your hand? Okay. What about 3? That's good. Okay. So the majority basically are not familiar with what I'm going to talk about. That makes me feel better. Okay. What exactly is meant by the term financial management? The people who raise their hands.
Management of resources.
Management of resources. What types of resources? Financial resources, such as?
Cash equivalents.
Liabilities.
Assets, liabilities. Now, generally speaking, when we talk about financial management, we talk about cash and cash equivalents, because with cash we can buy assets. And when we incur liabilities, that means we took cash. So cash basically is the general term that explains financial management. In particular, financial management is a process you use to put your numbers to work to make your business more successful.
Profitable.
Part of it is profitable. Now, sometimes the difference between failure and success in business is not general intelligence. General intelligence has nothing to do sometimes with success or failure. It is about using the right information to make intelligent decision making. And that's the topic, that's the tool that financial management provides for us. It's like, how can you use these information to make financial decisions? And that's what I'm trying, I mean, if I want to leave you with one idea today, it's this idea. How to use financial management tools to make intelligent decisions. Now, the idea about good financial management is not you can know if your business is doing well or not. It's why it's doing well, and if it's not doing well, why it's not doing well. It's not enough to know to know if your business is doing well or not. Later in the session, I will talk about the financial statements, and I will introduce the income statement. From its word, income statement means it's a statement that shows you the income at the end of the period, the end of the financial cycle. Now, if a company has positive income, that means it's doing well. The question is why it's doing well. Vice versa, if it doesn't have any positive income, if it has a loss. Again, why there's a loss. Finally, the idea of financial management is a tool so you can use to change some of your operations. If you think that X operations are not producing the results, then that's a sign that you may have to change these operations into different way of thinking. Now, every business should have a financial management system.
Sorry, I apologize.
Now, a good financial management system has many jobs, has many advantages. I can list 20 different advantages, but I will concentrate here on 4 different advantages. Now, a good financial management system will help you to manage proactively rather than reactively. Helps you to manage proactively rather than reactively. What does it mean?
Future cash inflows and outflows.
Exactly. Now, part of a good financial management system is to help you predict the future, to help you plan for the future. Because if you plan for the future, you're not a hostage for any events. You know exactly how to prepare yourself for any emergency, for any unexpected outcome, etc. Now, the problem is many organizations or many companies or many startups lack any basic skills in financial management. So then they are under the threat of losing a lot of opportunities because of that.
هاي في سيارة مرسيدس وفي سيارة سوبارو صفين قدام الصيدلية أيوة في اسمها
Yeah.
I was talking about the financial management system, and I was saying that many startups miss a lot of opportunities because they lack a good financial management system. Now, I think, I may be mistaken, I think none of you has any degree in business or accounting or finance, right? Which means only one. Two. Experience, okay.
6 years.
Not bad. That means the rest of you lack any information about basically the accounting standards or basic financial management systems. That means you have 2 options. Either you are forced to learn about these issues as fast as you can, or you may need to ask for help. You need to bring someone else to help you. Since we're in Arab Noor, I'll give an example how a good financial management system can affect your business. But it has nothing to do with financial management system. It has to do with pitching event. A couple of weeks, there was a pitching event in Ramallah. I don't know if you're familiar with it. They have the sign here, actually. Funded by the USAID. Many of the startups funded by Arab Noor were invited to the pitching event to present a 20 minutes presentation about their business. There were a lot of international investors that attended the event in addition to local investors. So for many startups, this is a lifetime opportunity. I attended some of these pitching events, so I saw at least 5 or 6 presentations. Omar was there. Now, I don't know if you share with me this idea, Omar, but many of these presentations were total failure. They have excellent ideas. Excellent ideas. But the presentation itself wasn't successful. Why? Because maybe the person who came up with the idea of the business lacks a simple skill of, presentation skills. So just bringing someone else who has this skill, like the presentation skill, could have made a big, big impact on this business. It's the same thing with financial management. If you lack the skill of financial management and you don't want to learn a new skill, simply don't hesitate to bring someone else. Simple as that for any business. Third, as I said, financial management provides financial planning information for investors. Sooner or later, if you have a startup, you will need extra cash. That's a fact. Now, as you know, you have several resources to tap into this extra cash. You can have a loan from a bank, or you can come to a place like Arab Noor or Solara to ask for funding. Or you can ask a friend, or you can ask a family member to contribute some cash in return for a share in your company. That's fine. No matter who you ask for help, who you ask for the extra cash, this person or this group or this business, the first question we'll ask you is, do you have a projected or do you have financial statements to show us what are you hoping to achieve in the future? Simple as this. Without these financial statements, no one will approach you. As simple as this. Not only you have to have financial statements, you need to make sure every number in these financial statements, why do you think this number makes sense? How did you prepare this number? Why did you come up with this number? What does it mean? What does it mean if this number goes down 10% or 30% or 50%? Without this information, you would expect these are basic information, but you won't succeed. I talk with a lot of these startups, especially in Arab Noor, and a lot of them are facing a lot of trouble preparing these financial statements. We'll talk more later in the hour about this. Finally, as I said, a good financial management system provides you with an excellent tool for decision making. If you don't know how much cash you have, how can you plan in the future? If you don't know how much sales you may generate during the next 6 or 7 months, how can you know how much expenses you will incur? If you don't know your expenses, how can you know if you had a profit or a loss this quarter or this year? Simple questions, but preparing them needs a lot of skills to be able to do them. Now, as I said, I will introduce maybe random concepts. One of the most important concepts in economics is something called opportunity cost. Why I decided to discuss this concept with you today, opportunity cost. Now, as you can see, the meaning of opportunity cost is the highest value that is surrendered when a decision to invest funds is made. That is, if you decided to start a business rather than look for a job, your opportunity cost is the salary that you could have made if you went into that job, but you decided not to. You decided to go for a business. Same thing. If you decided to establish yourself a good financial management system rather than bringing someone from outside to help you to do it, your opportunity cost is the time you wasted doing this rather than paying someone else from outside to do it. Now I can flip the coin and think from an investor's point of view. If I'm an investor and you need my cash, I have several options to invest in. One of the options is your company. But if I decided to invest in you, that means I have maybe other opportunity costs. I could have invested in stocks. I could have invested in a land. I could have invested in real estate. I could have invested in other companies. So my opportunity cost as an investor is the foregone return that I would have managed to have. Now the question is, to make it worth for me as an investor, my opportunity cost should be as low as possible. Now let me give you another example. If I decided to invest in a startup rather than investing in stocks, because historically speaking, if I decided to invest in stocks, I could make about 11% per year on average. If I decided to invest in a home, in land, in real estate in Palestine, I would have made at least 9% on average per year. If I decided to put my money in a savings account in a local bank, I would have got 0.2% per year. But if I invest in you, that means I won't be able to get any of these returns. Now I expect, because I invested in you, I expect at least you will provide me with something higher than 11%. Or else, why should I invest in your company? So as a startup owner, you have to think that way. What's the
Regarding the stock number,
Yeah.
isn't it a little too high?
No, actually, this is based on the Standard & Poor's Index. If you go 120, this is the average for the last 100 years, actually. If you take the average for the last region for the last 100 years, it's about actually 12%, not 11%.
Regional? Regional?
No, it's the American, yeah, the American stock. It's about, if you want to be precise, it's 12.3% on average per year. Now, some years it's 40%, some years it's minus 30%. Average is. In Palestine, land has been going up about 9% per year previously. Now, if I decided to purchase a car, that means I will lose the investment that I would have made if I purchased stocks or securities. Or, if I decided to purchase stocks, I will lose the opportunity to buy a home. Does it make sense? Any questions so far? Now, why I mentioned the topic of opportunity cost, because it's directly related with the concept of risk and return. Now, as I said, there are two different types of risks. There's something called systematic risk and something called unsystematic risk. Unsystematic risk, sometimes in financial literature they call it undiversifiable risk. Something that you can diversify, that is, you can't eliminate. If there is a war in Palestine, it doesn't matter if you have business in Ramallah or Jenin or Tulkarem, all of these businesses will suffer. It doesn't make any difference if you're a teacher or you own a pharmacy or maybe you have your own shop in Ramallah. All of these businesses will suffer. Everyone will be basically affected by this amount of risk. No. As investors, they look at this risk, but they basically focus more on something else. They focus on unsystematic risk. Unsystematic risk, it's a company or industry-specific hazard that is inherent to each industry. Each business has a systematic risk. Each business has unsystematic risk. That is, if a business fails because the management is not good, that is an example of unsystematic risk. It will affect only that business. It's not going to affect the whole market. If a business fails because the website of this business is not built according to certain standards, this is an unsystematic risk. This is because of this business. It's not going to affect me. In other words, as an investor, I will focus mainly on your unsystematic risk, on your business's basically unsystematic risk. I want to make sure that the unsystematic risk in your business is as low as possible. Now,
أنا عندي سؤال بس. لما تحكي when you say unsystematic risk,
Yeah.
I wanna like I really need the definition of it. So like يعني غير يعني تدريجي أو غير قابل إنك أنت.
Systematic risk, it's within the system.
Okay.
It's going to affect everything.
Systematic.
It's going to affect everything in the
So
system.
war يعني
It's a
systematic.
war, there's a, I don't know, there's a volcano, there's a tsunami. It's going to shock the system as a whole. Unsystematic risk doesn't affect the system. It affects within the system. One business within the system. As an investor, I look at this basically unsystematic risk. I want to make sure if I invest in company X or Y, I want to make sure that the unsystematic risk in this company is not more than other companies, or else it doesn't make any sense to invest in this company. Now,
So like if they have a faulty product,
for example, or if their model doesn't work well, or if their marketing plan doesn't make any sense, or if their financial management system doesn't make any sense. Now, I know this is, the whole initiative is called Start Me Up, right? So we're talking about startups. Now, I was reading about some statistics in the United States, in Silicon Valley in particular, and I know about 90% of startups in Silicon Valley, and Omar can certify this, fail. 90% fail. Total failure, like they close. That means the unsystematic risk within startups is high. It's very high. So as an investor, if I'm investing in you, I know the unsystematic risk is very high. It's very high. If I'm investing in startup and I know 90% of startups fail,
Okay.
that means the unsystematic risk within startups is very high. Now, the question is, why should I invest in something that has high unsystematic risk, where I can put my money in the stock exchange, stock market, and make 11% or 12% per year? There's only one rational explanation.
return عالية.
Return, high risk,
High return.
high return. That's the formula. The higher the risk, the higher the return. That is, if I'm investing in a startup, I expect at least providing me with more than 11%, because I can get 11% easily by investing in the stock market. No. Your financial management system should reflect this simple thing. When you think about a financial management system, I think about how can I offer my investor or any investor more than the 11%, the minimum 11%. Not only that, if other competitors, if other startups are providing their investors with, say, 20 or 30% per year, then any investor investing in me is expecting at least more than that, or else they can easily go to different startups. I'm actually. Let me now spend about half an hour talking about more concrete issues in financial management. One of the more concrete issues in financial management is financial statements. On Wednesday, we will talk more about preparing budget. We will talk more about equity formulas, etc. Sorry, no problem. But now I'll focus more about financial statements. Now, there are at least 3 major financial statements each business has to prepare. Something called income statement, balance sheet, and a cash flow statement. Now, what is an income statement? Income statements, as the name tells, it provides the income of the business. And there's a standard way to prepare an income statement. Usually the first line starts with sales or revenue or income from doing a business, followed by something called cost of goods sold. Cost of goods sold, or sales less cost of goods sold, is the gross profit. The gross profit is the profit you make simply from doing business. Like, if I buy this for 1 shekel and sell it for 2 shekels, my gross profit is 1 shekel. Now, each business has other types of expenses or other types of costs, such as operating expenses, wages, salaries, bills,
Insurance.
etc., marketing, production, transportation, consultation, etc. A lot of these expenses we should take into consideration. Now, the gross profit minus these operating expenses, there is something called operating income, or the total income that comes from operation. Less interest expense. If you take a loan, you're going to have to pay some interest, minus this interest expense, minus the taxes. I forget to add taxes. We will end up with something called net income. Good. Something called net income. This is an important number. It's the bottom line of any business. So usually, sometimes you go to a meeting and the first question that an investor would ask you, what's your bottom line? That means, what is your net income? Now, why this number is important then? One of the articles that I gave you to read is an article by Ben Horowitz. I forgot the name of the article. But basically, Ben Horowitz explains something very important. Now, in business or in finance, there is something called price-earnings ratio. Price-earnings ratio. Let me talk a little bit about this. Price means the price per share of any company. Like Amazon today, the price of the Amazon stock today is about $300. Now, if you divide this price by something called earnings per share. Earnings per share means the total income, the total net income, or the total earnings, divided by the total number of common stocks or the total number of stocks in the market. That is, say Amazon has 2 million stocks in the market. They issued 2 million stocks. And Amazon makes, says, $2 million per year. So $2 million, the total income, divided by 2 million stocks equals 1. As if every stock in Amazon earns $1. So if we do the price-earnings ratio, that is the market price, divided by this earnings per share, you have an idea how the market basically looks at this business. I'll give you a more complete example. On average, the price-earnings ratio for most U.S. companies is about between 15 to 23. 15 to 23. That is, for every dollar that a business earns, the market is willing to put in $15. For every dollar, the market is willing to put in $15 on average. Now, as the article showed you, sometimes this price-earnings ratio go way higher. It reaches 40 or 50 or 60. What does it mean? 50. 50 means for every dollar that a business earns, the market is willing, or investors are willing, to pay in $50 for it. 50 times the amount of earnings. Now, why does this happen? Why this ratio sometimes goes up, sometimes goes down? This reflects the general economic cycle. When there's an economic boom, or when an investor thinks that there's a lot of opportunities within these companies, they get more optimistic. When they get more optimistic, they are willing to pay more, and vice versa. When there's an economic recession or depression, that means there isn't a lot of money circulating in the economy. That means investors get pessimistic. So they are not willing to pay more. They are only willing to pay less. So what has this to do with startups? It's basically, if you pitch your startup, if you pitch your idea, when the economy is booming, that means you're talking to more optimist investors. That means they're willing to pay more, to invest with you and pay you more, and vice versa. So timing is a very important variable to consider when pitching. Now, going back to net income, sometimes you're doing a lot of profits, but investors are not that interested, simply because the economy is not helping. And sometimes some companies are not doing any profits, but investors are very excited about it. Let's go back to Amazon. I told you the average ratio in the market is about 15 to 23. What's the price earnings ratio for Amazon? It's about 400. It's about 400. What does it mean, the price earnings ratio for Amazon 400? That is, for every dollar that Amazon earns, the market is willing to invest or to value this dollar 400 times. It's 20 times the national average. Why are the investors willing to do this? Simply because they're optimistic about Amazon, and also they're optimistic about the economy in general. They think that the economy is booming, the financial or the economic recession is behind us, so we can easily invest more. In other words, to an extent, nowadays, you're in a booming market, especially in Rwanda. You would expect a lot of investors would appreciate your ideas. So maybe that's a plus. I don't know.
Regarding Amazon, is that the situation is that they spend the money on development and stuff like
True.
that? They don't distribute.
They don't have profit.
It's profitable, but
But they don't have that.
yeah, exactly.
That,
They make that choice. It's not.
Yeah.
Yeah. That's what.
True. I apologize if the you'll have some hard copy samples of some of these financial statements. But basically, financial statements looks something. I don't know if you can you see it well?
No.
No. Okay, maybe I should change the
Color. Remove the red color.
the color. You know what? I'll make it easy for you. Maybe we can distribute the hard copy. You'll have more opportunity when you look at the financial statement. No.
Thank you, Katie.
I was talking about income statement. So the income statement will look something similar to this. Now, you'll see the first line. It's an income statement, the name of the company, etc., and there is the date. January 1st, 2008 to December 31, 2008.
Ziad, can I just stop for 1 second? Is there a group that has 2 sets of papers, perhaps?
I have the original copy. If
Oh.
anyone,
'Cause
there's something
we're
missing.
having,
They can use
we're
the
having a
original
complaint on this side that they don't have a set of papers.
copy. Use this. This is no, I think I have something else.
Pretty much, yeah. Thank you, Ziad. Ah,
One extra, no?
you guys have the extra ones because you removed the clip.
مش قلت لك خلينا اشيله.
لا بدي أشيل.
One extra because someone is.
بدي أشيله.
So I can take mine now.
تفضلوا.
Thank you, Mahmoud.
Can we? Yeah. So, as I was saying, the financial statements look something like that. First of all, the financial statements represent the income statement represents the income for a certain period of time. Now, it could be a month, it could be a quarter, 3 months, or it could be 6 months, or it could be usually 1 year. As a small company, sometimes you're a beginning company, startup, you can always do income statements like a week. That's very typical. As I said, it starts usually with sales, gross sales. Now, sometimes some sales or some customers they return their purchases. That means there is an allowance for returns. So gross sales minus the allowance for returns, you end up with net sales minus the cost of goods sold. You end up with the gross profit. Sorry, I don't have a pointer, but minus all the operating expenses. And as you can see, the operating expenses include at least 8 different types of expenses, from salaries and rent and property taxes to depreciation, utilities, etc., etc. You end up with operating expense, or the total operating expense, minus interest expense. You ended up the last or the bottom line with your net income. Now, if you have tax expense, you would easily deduct the tax expense after you deduct the interest expense. If you don't have taxes for any reason, then that's how it's going to look like. Now, another statement we will look at today is the balance sheet. Balance sheet is a simple statement that shows you the assets of the business, what the business owns, and how did you finance these assets. Usually assets are financed either by your own money, your own investment, or if you took a loan, took a credit, a liability. So that's why usually the balance sheet is divided into 2 sections. The left-hand side of the balance sheet shows what you own as a business, all the assets that you own. And the right-hand side of the sheet shows the liabilities, or the investments that, as individuals, you put in that business. Now, generally speaking, assets, it's an accounting fact, I don't know why, but assets usually is divided into 2 sections. Short-term assets, or current assets, and long-term assets. Short-term assets, or current assets, are the assets you expect to use within the current accounting cycle, within the current accounting period. And when I'm talking usually about an accounting cycle, I'm talking about usually 1 year. So any asset that you think you will use within a year, it is included under the current assets, such as cash, accounts receivable, and inventory. Now, any asset you think will last more than 1 year goes under the fixed assets, sometimes they call it the long-term assets, such as land, building, cars, equipment, etc. Now, this is the left side of the balance sheet. Now, the right side of the balance sheet has the liabilities and the equity. The liabilities basically are the loans that you took. And usually these liabilities are divided into 2 different sections. Short-term liabilities, or current liabilities, and long-term liabilities. Current liabilities are the loans that you expect to pay within 1 year or less, a year or less.
Or I'm expecting to
Expected.
use current assets to pay those liabilities.
Exactly. Now, the long-term liabilities are the loan you expect to pay after 1 year. So any loan that is 3 or 5 years will go under the long-term liabilities, or that any loan you expect to pay less than 365 days will go under the current liabilities. Now, total equity basically is the money that either you invested yourself or the money that other investors joined with your investment. Now, don't worry about the preferred stock or the common stock or the paid capital. These names are basically related to large corporations. As a startup, you will have one simple equity. That is Your equity, the money that you invested. And if someone else invests with you, there's going to be two sections: your equity and X's equity, Arab Noor's equity. So, but after all, this total amount of equity is added together under one
Consolidated.
number, total equity. The balance sheet, unfortunately, I'll have, I think, an example for a balance sheet here. Now, one of the most important statements as well we'll talk about today is the statement of cash flows. From the name, it shows the cash inflows and the cash outflows. How much cash you brought in and how much cash you were spent during the period. Now, for more accounting reasons and for decision reasons, this cash flow statement is usually divided into three different parts. The first part is cash flow from operating activities. All the cash inflow and outflow that is related to operations, such as if you pay rent, rent is related to operation. This is a cash outflow. If you paid salary, salary is related to operation. This is a cash outflow. If you did some maintenance, this is maintenance related to operation. This is a cash outflow. If you brought in some sales, if you sold, or you had revenue or sales related to your business, this is an operating cash inflow. So it is reported in the operating activities, cash flows. Now, the other section is cash flow from investing activities. If Arab Noor invested in you, this is a cash inflow. If you return the money to Arab Noor a year later, this is a cash outflow. Any inflow or outflow related to investment goes under this section. And finally, cash flow from financing activities. If you took a loan, this is a cash inflow related to financing. You financed yourself through a loan. If you paid a loan, this is a cash outflow related to financing activities. If you paid interest on a loan, interest is related to financing activities because interest came from a loan. A loan goes under financing activities. It may be complicated, but it's many softwares nowadays or applications nowadays simply prepare these financial statements easily. You don't need to be an expert, or you don't need to have a certificate in accounting to be able to prepare these financial statements. As I said, many local corporations here provide you with simple, easy to use apps to prepare these statements. But you need just to know the basics for these applications. Now, this is a statement of cash flow. Again, we have the same problem. Let me just I don't want to go into details on this statement, but you see a cash flow statement. You see the cash flow statement is divided into three different sections. The first section is titled cash flow from operating activities. In the middle there is cash flow from investing activities, and at the bottom there is cash flow from
Can you
financing activities.
Zoom in.
zoom in, please?
Yeah.
عصام عصام اسكت ولا بلاش نفتح ملفك.
ايوه
بعدين بتصفي زي محمود.
How about that? Seems right? No. Now the only thing I want to show you is you see some numbers are between brackets and some numbers are not. Now, if a number is between brackets,
Minus.
that means minus, outflow. If it's not, it's inflow. You'll use this when you look at the financial statements you have. Now, some softwares, rather than using brackets, use the color red. If a number is in red, that means it's minus. If it's black, it's plus. It's the same. And with that, we come, I think, to the end of financial statements. You'll see you have 4 different companies, and for each company you have the balance sheet, income statement, and cash flow statement. Now these companies are as follows. One is for Apple, one is for Google, one is for Twitter, one is for LinkedIn companies. Now, using the financial statements without telling you which is which, can you tell me which set belongs to which company and why do you think this is it? What do you think this set is for Apple? They are the true numbers. They are the true financial statements. Right? Now each. Right, sir. No, never mind. The exercise, right? We did manage to match the financial statements. Let's just make sure that you get it right. First, you started thinking by dividing the 4 companies into two different groups. You have Apple and Google, the big, the large, profitable companies. You have LinkedIn, Twitter, smaller, maybe not that profitable companies. And as most of you looked at the income statement, you looked at the net sales, the first net sales, the statement with the largest net sales, 179.10. 170 مليار 910 مليون. They have the largest amount of sales among of these companies. And remember, some other group, they looked at the operations. They thought, exactly, operations, Apple basically has a lot of iStores around the world. Technically, they have a lot of employees. Technically, they have high number of operating expenses. So they looked at the operating expenses and they thought simply the company with the highest operating expense should be. Makes sense as well.
If you look at the inventories,
Makes sense. If you looked at the balance sheet, for example, you looked at the balance sheet, the company with the highest amount of inventories, and again, since Apple is a manufacturing company, they have a lot of finished products, they have a lot of raw material, etc. They have a lot of stores. These stores have inventories, so technically they should have the highest amount of inventory.
You will find the inventories under the
balance sheet. If you look at the balance sheet, if you go to the current assets, if you look at the 1, 2, 3, the 4th line, they have inventories 1,746, which is $1,764 million worth of inventory. Makes sense. Now, then, now as I said, which leaves the other big revenue for Google. If you look at the Google financial statements, the one with 59,825. This is the revenue for Google. 59 مليار 825 مليون, almost 60 billion for 2013. Now, some other way to look at Google is how I knew it. I know Google does a lot of research and development. You know, they're trying to do the drones, they're trying to do the self-driving car, they're trying to do what else?
iClass.
The eye, exactly. No, actually, I was reading about it. You know, the lens, the smart lens.
Puppet recognition, I think. Puppet recognition.
Exactly, the smart lens that can measure the sugar level in diabetic people. إذا أنت بتلبس عدسة، إذا واحد معه سكري، هذه العدسة بتقيس لك السكري وتبعت لك مسج على الايفون تبعك. قديش السكر، فكل ما يطلع عندك تبعت لك تكست إن السكر عندك عالي.
كمان from the cash paid to investing activities, Apple's done in purchasing a lot of investments, a
True.
lot of R&D.
True. They are acquiring a lot of other smaller companies and stuff. So, you can tell from these hints that, this company is high research and development. They don't have a lot of high revenue, but still way higher than Twitter and LinkedIn. What else differentiates Google? What else differentiates Google? They have assets as well. They have a lot of assets. Their total assets is about 110 billion US dollars, almost 111 billion dollars. Why? Because they own a lot of companies, they own a lot of land in the United States. What else? Yeah, they have a lot of cash. If you look at their cash flow statement, Google is a big company. It has been in operation for a while now. They collected a lot of cash, which allows them to buy other smaller companies. Please.
There's an item, it's gain loss on sale of assets, minus 57 in 2013.
In Google as
In
well?
Google, yeah.
Income statement. Gain loss on sales of assets minus 57 million. So basically that means they bought the land for, let's say, 1 million. They sold it for 43 million. So they sold the asset, the land most probably, for less than what they acquired it for.
For less?
For less than what they acquired it for. Most probably they sold the land, they bought the land like a while ago, and they sold it for less than the cost.
خسروا من
خسروا بسعر الأرض. أغلى.
او اشتروا سيارة وباعوها.
Yeah. Most probably because I was reading about Google. Google buys a lot of land.
For California, that makes sense.
No, I think, if I'm not mistaken, Google buys a lot of land to build warehouses for their servers.
Solar system.
So, they changed the location of their servers. I don't know if you read about it. A while ago, Google decided to change the servers of many of their locations. So they sold the land where the current servers were, and they bought new land. And I think they lost money on these pieces of land as a result. But for them, losing 57 million is nothing. After all, their total income is 13 billion. It's the change. Now, as you rightly said, the other two companies then should be Twitter and LinkedIn. The problem is which is which? Which is LinkedIn and which is Twitter? Now, we know that which is newer to be a public company? Actually, it's Twitter. Twitter is newer. Now, some of you said, since it's the US, I would expect it's not making a lot of profits. It could actually be making losses. And one of the income statements you have, the net income is minus 645 million. So a lot of you said, oh, since this company is losing, it should be Twitter, since it's the newest one. That's what they said. The other one, what's the net income for the other one?
And then 1 billion.
LinkedIn, the total income is 26 million, almost 27 million. So now we have two companies, two small ones. One is making 27 million, and one is making 645 million in loss. But that doesn't give us a sign which one is Google, which one is which one is Twitter, which one is LinkedIn. So we have to look at your hints when we look at financial statements. Now, can you tell me the people who guessed it right, please?
Twitter doesn't have any source of income, so the one with the losses is Twitter.
That's one way to look at it. So far, Twitter doesn't have a good stream of income.
True.
They don't have, and we know that LinkedIn has some income.
Yeah.
It's free to open a LinkedIn account, but for businesses, sometimes they pay fees for LinkedIn to access some
Through
of their
accounts.
accounts.
Premium accounts.
Exactly, or premium accounts. So they have to an extent, a source of income. to make sure, if you look at one of the financial statements, if you look at the cash flow statement. So yes, the one that is making the loss is Twitter, and the one that is making a small income is LinkedIn. But to make sure, if you look at the cash flow statement for LinkedIn, the one with the 26 million income, you will see that they have a positive cash flow from operating activities. That is, their operations are providing them with cash flow. But if you look at the cash flow statement for Twitter, you'll find the cash flow statement from operating activities is in minus. Makes sense. For most of the small companies, for most of the newly established companies, their cash flow from operating activities usually is in minus. That's where the term burning cash comes from. You burn cash usually when you're starting, because you have a lot of expenses. You have marketing expense, salaries, you're bringing a lot of employees, you're renting space, etc., etc. So that's why you burn a lot of cash. That's why most of your cash flow from operating activities in minus. Now, how can you bring cash to satisfy this extra burning cash? Then you have either to go and get more loans, or you have to issue more stocks. You have to get more investments. So that's why their cash flow from financing and investing activities is in plus signs, while as their cash flow from operating activities is in minus. Now, since LinkedIn, to an extent, has a winning model now, winning business model, some of their investments or some of their operations are bringing in cash. That's why they have a positive cash flow from operations, and they have a positive net income. Now, if you look at LinkedIn, but you don't look at 2013, if you look at 2012 or 2011, you will find that actually they were doing good in 2011, 2012. But if you look at their income in 2011, it was about 12 million. 2012 is 22 million, and then 2013 is 27 million. So you're seeing a gradual increase in income while the company matures. So,
No, it's like you said gradual, but in 2010 they were 15, but then they went down to 11.
I'm English after 2010, 2011. I have a different company. That's what you have to look on the financial statements to see why between 2010 and 2015 the net income is reduced between from 10 to 15. Unfortunately, I don't have in my statement because I have different financial statements. So I didn't have the chance to look at. This is the one? Yes. Let's see if we can tell what's the issue here. Net income was 15, now it's down to 12. Where the problem is?
Is it capital expenditures, other investing cash flows from investing?
Look at total operating expenses. Total operating expenses in 2010 is 223 million. Total operating expenses in 2011 is 496 million. So the total operating expenses between 2010 and 2011 doubled. The total operating expenses doubled from 223 million to almost 500 million. Now, if you look at revenue, it doubled also. Revenue in 2010 was 243 million. In 2011 is 522 million. So the revenue doubled, the total operating expenses doubled. But one of the expenses, let me see which one I lost it. One of the expenses more than double. It is the selling general administrative expenses. Selling general administrative expenses. It used to be 94 million in 2010. In 2011, it's 240 million. It's more than double. It's like 250% more. So this expense in particular basically affected their net income, which means between 2010 and 2011, LinkedIn decided most probably to increase the number of total employees, since it's growing. So one way to grow is to hire more employees. As a result, their selling and general and administrative expenses increased as well. And the increase was way higher than the increase in income. So the income doubled, but this expense more than doubled. As a result, the net income slightly is less than the previous year. There's like a 4 million difference. Not a big amount, but basically most probably this is the reason. Again, to an extent, this is typical for any growing company. And with that, we come to an end.
I have a question.
Please.
For startups that want to get listed on the stock market, what do they need? 2 years of financial statements, $2 million of revenue annually, or which stock market, NASDAQ or the Palestinian stock market in particular?
Oh, okay. The law here, you need at least financial statements for the last 3 years. 3 years, and you need projections for the next year as well.
And the financial statement has to be a certain amount annually, 2 million? How much should the company be making?
At least total sales 25 million if I'm not mistaken.
Total 25 million a year.
But there is a new investing law in Palestine. They are revising the law, investing law in Palestine. Part of the new law is to encourage more companies to list on the financial stock market. So they're trying to
Lower.
to lower.
Yes.
But I can double check about this actually and make sure to let you know next.
Okay.
It would probably be on the Capital Markets Authority website, PCMA.
I just confused.
Although since I got here 3 years ago, since the first time I've come, they've been revising this law.
Still there.
I won't be hopeful anytime soon about changes.
Talk to Firas about it.
It's good and bad, and that's why you get a lot of mergers between organizations and banks. Part of the reason that these banks are forced to merge together because standing alone they can't qualify to list their stocks in the financial stock exchange. So they have to merge with another bank so they can qualify.
البنك الإسلامي والبنك
البنك التجاري وبنك بنك. So any questions?
Thank you.
I hope I didn't bore you. Hopefully next session I can bring in some of these same concepts and we will introduce more concepts. I will talk more the next session from an investor point of view. How investors look at it as a new stuff. What are they looking at and how to think about it as new startups. So let's see how it goes. With that, thanks.
Thank you.